provisions and tax, excluding treasury income, increased by 25.8% year-on-year to rupees 6,077 crores in Q4 2019. For FY 2019, the core operating profit grew by 16.5% year-on-year to 22,072 crores. The NII increased by 26.5% year-on-year to 7,620 crores in Q4 2019. The net interest margin increased from 3.4% in Q3 2019 to 3.72% in Q4 2019. There was interest on income tax refund of rupees 414 crores in Q4 2019. For FY 2019, the NII increased by 17.3% year-on-year to rupees 27,015 crores, and the net interest margin increased from 3.23% to 3.42%. The fee income grew by 15.4% year-on-year in Q4 2019, driven by retail fee. Retail fee income grew by 15.3% year-on-year in Q4 2019 and constituted 74% of the total fees. For FY 2019, the fee income grew by 15.9% year-on-year to rupees 11,989 crores. The domestic loan portfolio grew by 16.9% year-on-year, driven by a 21.7% year-on-year growth in the retail portfolio. Growth in the domestic corporate portfolio was about 14%, excluding net NPAs and restructured loans. We had a very healthy growth on our funding side. Total deposits grew by 16.4% year-on-year. In absolute terms, the total deposit increased by rupees 91,944 crores during the year. Average CASA deposit grew by 14.2% year-on-year in FY 2019. The period-end CASA ratio was 49.6% at March 31st, 2019. The net NPA decreased by over 50% year-on-year to rupees 13,577 crores at March 31st, 2019. The net NPA ratio was 2.06% as at March 31st, 2019, which is the lowest in the past 13 quarters. The provision coverage ratio on non-performing loans, including technical write-offs, increased from 60.5% at March 31st, 2018 to 80.7% on March 31st, 2019. Excluding technical write-offs, the provision coverage ratio was 70.6% as of March 31st, 2019. The gross additions to NPAs were rupees 11,039 crores in FY 2019, significantly lower compared to rupees 28,730 crores in FY 2018. Gross NPA additions were rupees 3,547 crores in Q4 2019. The gross NPA additions in Q4 2019 included an account in the sugar sector where the payment obligations were being met, which has been classified as a non-performing asset pursuant to regulatory interpretation communicated to banks relating to change in management. The annual supervision process of the bank by RBI for FY 2018 was concluded during the quarter. The divergence in asset quality and provisioning of NPAs do not require any additional disclosure in terms of the RBI guidelines. We expect the credit cost in FY 2020 to reduce significantly compared to FY 2019 and move towards a more normalized level. Treasury income was rupees 156 crores during the quarter compared to 2,685 crores in Q4 2018. Treasury income in Q4 2018 was substantially higher due to gain of rupees 3,320 crores on sale of shareholding in ICICI Securities. The bank's standalone profit was rupees 969 crores in Q4 2019 compared to rupees 1,020 crore in Q4 2018. For the full year 2019, profit after tax was rupees 3,363 crores compared to 6,777 crores in FY 2018. The profit after tax in FY 2018 included a gain of rupees 5,332 crores from the sale of shareholding in subsidiaries compared to 1,110 crores in FY 2019. The total capital adequacy at March 31st, 2019 was 16.89%, well above the minimum regulatory requirement of 11.03%, and a Tier 1 capital adequacy of 15.09%, well above the minimum regulatory requirement of 9.03%. The Board of Directors has recommended a dividend of rupees 1 per equity share on the face value of rupees 2 each. Going forward, we will continue to maintain our focus on growing the core operating profit in a risk-calibrated manner. We believe that there are a lot of opportunities in the financial landscape, and we are geared to maximize the bank's share of these opportunities. We will continue to grow our deposit franchise, leverage the recent technology partnership, and focus on deepening the penetration of our product and services among our existing customers. We will continue to invest in technology to expand our customer base, enhance customer service further, and offer new products. We are striving to make our delivery to customers even more seamless and frictionless by decongesting our processes and appropriately empowering the teams. We have recently reorganized ourselves to work together seamlessly across functional and departmental boundaries in order to maximize our share of our market opportunities. We will align solutions to provide the full range of banking service and capture the opportunities concentrated around economic ecosystems. We believe we are at the end of this asset quality cycle, and the NPA additions are expected to broadly stabilize going forward. With a robust deposit franchise, a strong capital base, we believe we are well positioned for the growth in the coming quarters. We continue to be committed to achieve a consolidated ROE of 15% by June 2020. With this, I conclude my opening remarks. We would be happy to take on any questions.
Movement which is there. Otherwise, 15% for the year is a better trend to look at.
Sir, if we just remove the ICICI stake sale, can you give us like-to-like numbers of this year versus last year?
In the sense that ICICI, the profit on sale of shares in ICICI was about 3,300 crores last year.
Yes.
That is that is something which is not there this year. So you can
So you just adjust that straightforward?
If you would wish to, we have not reported that as an adjustment. It was income that we had made in the Q4 of 2018, and the amount was 3,300 crores.
Yes, but sir, if you look at it, even in the quarter 3 of this year, the other income is slightly higher than this time, even if you adjust for those numbers. So I just wanted to check: is there anything that we have missed?
No, the fee income is up 15% year on year.
Okay.
Some of the dividend income, could be marginally be lower. Otherwise, the trend is on the other income is pretty much in line with earlier, quarters.
Sir, you mentioned a couple of points on the credit cost as well as the way forward. I think you said ROE of 15% by June 2020?
That's right.
So what's the, can you throw some light on the credit cost and how you think it's going to be in the next financial year?
We expect it to be more normalized during the next financial year, as I mentioned.
Thank you. I would request Mr. Rebello to come back in queue for follow-up questions. The next question is from the line of Ritu Singh from CNBC TV18. Please go ahead.
Hi, Mr. Basu.
I'm sorry, Ms. Singh, we can't hear you. Can you please speak on the handset mode?
Yeah, can you hear me now?
Yes, thank you.
Yeah, my question was on the slippage front, 3,547. How much of it has come from the sugar account? If there were any other chunky slippages, if you could give us a breakup of that and the provisioning that you've made. Secondly, I also wanted to understand, is there a specific number you could give us when you say credit costs next year will be significantly better than what we've seen in the past few years?
So, in terms of, we have not, as you know, we don't disclose our exposure to individual, borrowers. So that's why we have not, talked about the loan outstanding to this, sugar company. But, it is a meaningful number, which is there. And that's why, Sandeep had highlighted it, earlier. Otherwise, the additions that we have seen in the quarter, the additions on the retail front have been absolutely normal and stable. And bulk of the additions on the corporate and SME have come from the BB and below rated portfolio, other than this particular sugar account, which is there. On the credit cost, going forward, as Sandeep mentioned, we expect a significant decline, from the trend that we have seen in FY 2019. It's difficult to say a particular number per se, but it will be a significant decline. You have already seen that the NP additions have come off substantially in FY 19 itself. So it will be a significant decline, and we'll get much closer to a normalized level of credit costs.
So to just highlight a couple of points, I mean, if you see our PCR, the provision coverage ratio at over 70%, excluding technical write-off, is one of the highest in about 21 quarters. And the NPA ratio of about 2.08% is one of the lowest in another 13 odd quarters. So I mean that's probably an indication of from your perspective.
So of these slippages, how many were from the watch list? How many from your restructured book? Could you give us that breakup as well?
So the as I said, outside the BB and below portfolio, from the corporate and SME side, the slippage was about 8.5 billion rupees. And that was largely this one, sugar account.
Okay. Since we're doing this con call, if you could also highlight for us, there have been reports in Indian Express specifically, where, there have been some questions raised on the bank's loans to SR Steel Group, specifically to SR Steel Minnesota, which the report claims was then used to repay the bank. It was evergreening, where RBI had raised questions in 2014, which were covered up. I just wanted to understand, has there been any further inquiry from RBI on the matter, and any other clarification that the bank could give if it could have any sort of impact on your balance sheet?
So we have already given the query responses to this in January. We really don't have any further comments to make on this matter. These things don't have any impact on our financial results, and whatever appropriate action we have to take, we have taken.
Thank you. We move to the next question, which is from the line of Neha Bothra from ET Now. Please go ahead. Neha, your line is in the talk mode. You may go ahead with your question.
Right. Hi, this is Poonam Sani from 80 Now. So if I'm looking at your slippages again in terms of your entire asset quality, what has really led to the reduction is the higher amount of write-offs during this quarter. So I have a three-part question related to the asset quality. A, what is the reason for such a high write-off during this quarter? And would this mode be followed in terms of reducing the NPA stress going ahead? B, again, if I'm looking at your the commentary that you just gave, BB rated book still stands at nearly around 17,000 odd crore, and we did see substantial slippages on the corporate and SME book during this quarter coming in from the BB and below rated book. So how much of the BB and below rated book could really go ahead and slip during the next few quarters? And also, what is the reason, what is really giving you the confidence that the credit cost would be substantially lower in FY20, because you do still have to make good amount of provisions even for the IBC related accounts, and the environment is still tough overall?
So, we missed your initial part of the query. I think it was on the level
write-offs.
On the level of write-offs. So, as we have said, we have written off about 7,000 crores of loans during the quarter. For the year, the write-offs were about 11,000 crore. Last year, the write-offs were about 8,600 crores. So if you look at on a year-on-year basis, there's nothing, much different in terms of the trend which is there. So depending on our, assessment and the policy that we have on write-offs, the write-offs will move, accordingly. These write-offs are of fully provided cases. So as such, they don't really have, any impact, from a P&L perspective. It does bring down the gross NPA ratio, and also it results in a lower, provisioning coverage because of the reduction from the provision levels. In terms of your next question was on the
double B and below rated book.
Double B and below rated. So if you look at the portfolio now of double B and below, it has come down to 17,500 crore. If you look at our total loan portfolio, which is there, which is close to touching 6 lakh crore. So it is around 3% of our total loan portfolio. For any bank, there will always be a part of the portfolio which will be below investment grade. So we are seeing that those numbers are now coming down to a much more normalized level compared to where they were, even a year back or a couple of years back. So that is definitely, comforting, and we have seen the net number declining in the double B and below portfolio. Incrementally, we are lending a lot more to the A minus and above rated, clients of the long-term disbursements. A very high percentage is to, such customers. So that is what gives us the comfort in terms of the incremental NPL additions, for FY 2020. And then the provisioning is a resultant of that. As Sandeep mentioned earlier, given the fact that our provision coverage ratio overall is already at 70% and including technical write-offs at 80%, that also means that on the existing portfolio, the kind of provisions that we were required to make in FY 19, because we started the year with a 50% coverage ratio, that will no longer be there in FY 2020. And that is again, something which gives us the comfort.
Right. Hello?
Yeah.
So I also wanted to ask you about the exposure, the bank exposure to Reliance ADAG, and how much risk do you see there in terms of NPAs, and what kind of accounts do you have still standard on your books?
So we don't disclose, any individual borrower or borrower group exposure, separately. As I said, the overall portfolio, which is internally rated double B and below for us, that is 17,500 crores.
3,500 crores.
Sorry, the double B and below rated portfolio is 17,500 crores. We don't
have
individual borrower exposures.
So Reliance ADAG will be a part of that double B and rated below.
It will depend on the rating of the individual borrowers. We don't disclose about individual borrowers.
And
sorry to interrupt, Poonam. I would request you to come back and queue for follow-up question. The next question is from the line of Radhika Marvin. Please go ahead.
Yeah, hi, good evening, sir. I wanted to understand the provisioning that you made on the ILFS account. How much of this provisioning was made in this March quarter? Was the amount that is shown in your notes to account the entire provisioning made this quarter, or there was some provision that was made in the December quarter as well?
So, we have given the position, as of March 31st, 2019, as is required, by RBI. But it's fair to assume that a fair bit of these provisions would have been made earlier in the December quarter itself.
Okay, because we don't remember seeing these figures of non-fund exposures. I was wondering whether the reason for the significant provisioning in the March quarter is because of this.
No, so, this is a disclosure we have made because, RBI had asked, banks to provide their individual exposures to, ILFS-related entities. The provisions, as I said, while some amount, could have been made in this quarter, but a large amount would have been made earlier itself.
Could you explain then that why the provisioning is, kind of high this quarter, considering that you've seen a substantial reduction in your NPA positioning?
So the provisioning, it is a function of the, aging of the NPA, portfolio. So depending on, which bucket the portfolio moves into in terms of the RBI guidelines of, substandard, doubtful 1, doubtful 2 category. As the NPAs age, there is a provisioning requirement, which comes in. So it is based on the normal aging, the provisions have come in.
Okay. And out of the gross slippages, how much has been from the stress book, I mean the BB and below book this quarter?
As I said earlier, of the total, slippage which has happened from the corporate and SME, portfolio, that is about 2,700 crores, out of which 850 crores is from outside of double B and below, which is largely the sugar account, which we earlier referred to. And the balance amount, which will be about, close to 1,900 crores, would have been the double B and below portfolio.
Thank you. I would request Ms. Marvin to come back and queue for follow-up question. The next question is from the line of Manajit Saha from Hindu. Please go ahead.
Yeah, hello, sir. What kind of loan growth do you expect for the current financial year?
We don't give forward-looking statements, my friend.
Also, do you think the run rate of slippages in this financial year will come down substantially as compared to the previous year?
So the run rate actually for FY19 itself has come down substantially. We are at about 11,000 crore of additions compared to close to 29,000 crores in FY18. So that run rate has already come down in FY19. Going forward, what we were saying is that the provision, the loan loss provisions will come down substantially in FY20.
Loan loss provision will come down. And what was the credit cost for FY19?
FY19, the total provisions we have taken is about 19,000 crores.
No, credit cost.
As a percentage of advances would have been, it's been pretty high, like in the earlier quarters, itself. So, close to 3.5%.
3.5%, okay.
Yeah.
Which you see going forward will normalize.
Yes.
3.5%. Okay, thank you.
Thank you. The next question is from the line of Bina Parmar from VC Circle. Please go ahead.
Hi. Sir, I just wanted to know what do you think of the latest update on the whole insolvency process and, given the delay especially the delay in the SR stream we've seen, you also have exposure, I believe. So if you could throw some light on the latest developments on the insolvency, how do you see the progress going forward?
On this, actually, it's not exactly pertinent to our quarterly results. But in general, I think there has been a lot of positive movement as well from the IBC, not just on the resolution, but in general, it has meant that the borrowers have become much more disciplined in terms of their repayments to banks. It is a new law which has come in over the last couple of years, so there will definitely be some teething issues which will be there. So those are, I guess, getting sorted out. So while there have been delays, we are quite confident that the process will get completed, going forward, and we'll have to go by, what the process is. So we are quite positive on the impact of the, IBC for banks, and these delays are something which, we have to live with.
But are you worried that after the whole February 12 circular being struck down by the Supreme Court, will things change with the way banks approach NCLT?
Nothing will change. I think we are all waiting for RBI to put out, as they have said, they'll be putting out a revised guideline, and then we will see, how that goes.
All right. One last thing, any update on the whole ICICI Home Finance subsidiary? We've heard that it is looking at buyers, but we've not seen much movement.
No, there's nothing like that. We have said earlier also that, the company is extremely focused on, growing their, home loan and related business, and that's what, they are working on.
Have you dropped the idea of selling it?
That we have said quite some time back that we are focusing on growing that company.
I see. Okay, sure. Thanks a lot.
Thank you. The next question is from the line of Surbhi from Hindu Business Line. Please go ahead.
Hello.
Yes. Yeah.
Hello. Hi, sir. Last 2 quarters, we've seen that the bank has reported a drop in its net profits. Can you give us some indication of what is expected in the new fiscal?
So we have said on increasing our core operating profit, and we do expect that the provisions to be normalized. So based on that, you can make an assessment of the growth in profits. And we have also said by June 2020, we will try to achieve an ROE of 15%.
And what is your customer base right now exactly? Hello?
We'll get back. I'll get back to you on this.
Okay, sir.
Thank you. The next question is from the line of Panika Soki from Money Control. Please go ahead.
Hi, sir. So I just wanted to understand what is your comfort level with the current capital adequacy right now, considering your growth plans for the current year and, the provisioning needs and all. And also, are there any plans to raise funds in FY20?
So we continuously assess our capital requirements. At this point of time, we are very comfortable with the capital position. In case we need to raise capital sometimes in future, we will evaluate it.
currently our Tier 1 capital is 15% against a minimum requirement of 9%. So, we are extremely comfortable on capital position.
So no plans as of now for the rate hike this year, or you may come up with something in the second half?
As of now, we are extremely comfortable in the capital position, and any plans which are there, we will see as things evolve.
Okay, all right. Thank you.
Thank you. The next question is from the line of Aparna Iyer from Mint. Please go ahead.
Hello. Yeah, this is Gopika here from Mint. Hello.
Hi, Gopika.
Yeah, hi. Sir, can you give me a breakup of the credit growth, please?
We said that the domestic retail has grown by about 21%. So overall growth has been 16%, the domestic one. Within that, the retail group, grew by 21%.
21.7, yeah.
What about SME and corporate?
SME was around 20%. And corporate, if you look at the corporate portfolio, excluding the NPA and restructured portfolio, that was around 14%.
Okay. Overseas book?
Overseas book was, marginal decline.
Okay. What is the status of your Canada subsidiary in terms of capital?
They're fairly well capitalized at this point of time. Both UK and Canada are well capitalized.
But you were sort of bringing back that capital from Canada.
Oh, we have bought in whatever capital that we needed to bring from both these entities.
Huh.
Now we are using it for the business that is there.
Okay. No further.
No immediate plans of reducing the capital further.
Okay.
We think they are appropriately capitalized at this point of time.
Okay. Fine. Sure. But would you look at expanding both the books? I mean, is that both three books, UK, US, and Canada?
The US is part of our branch. I mean, we are looking at our overall international strategy too, as part to be increasing profits on a risk-calibrated basis. So wherever the risk-calibrated profits come from, we are happy to grow that. We really don't have a specific plan across any business segment.
Thank you. We move to the next question, which is from the line of Mitali Salin from Financial Express. Please go ahead.
Hi, this is Sritama Pinati. My question is, your NIM seems to be the highest in quite a few quarters now. So what exactly has driven this boost in the margins?
So, if you look at the last couple of years, our funding profile, has been improving continuously through this period. And even in the last financial year, as the funding cost has, gone up, we have been able to, raise deposits and be liquid enough to not rely on, higher cost, funding, options. Plus the increase that we have seen on the funding cost, we have been able to pass it on to the lending side as well. That has meant that we have been able to improve, our margins, through the year. So compared to, the 3.23% of last year, we were able to increase that to 3.42% for the full year. For Q4, the margin is 3.72%. Again, as Sandeep mentioned earlier, it does include the benefit of 400 crores of interest that we have got on income tax refund, which is also a part of the 3.72%. But even aside from that, the margin has been increasing on a quarter-on-quarter basis.
All right. And you believe these numbers are sustainable, this kind of margin, over the next year?
So if you look at the full year margin of 3.42% that we have, going forward, we will definitely, strive to maintain and maybe marginally improve from that level.
Okay, thank you.
Thank you. The next question is from the line of Rahul Satija from Bloomberg. Please go ahead.
Yeah, hi. So the first thing I want to ask is, which are some of the areas where you are closely watching out for stress? Other bankers have mentioned auto sector to be one of the sectors they are closely watching. What are some of the areas that ICICI Bank is looking at?
I think in the past, we have mentioned that, for example, the real estate, portfolio in terms of loans to developers is one thing that we are, closely monitoring. If you look at, the Kisan, credit card portfolio, because of the impact of farm loan waivers on that, possible impact on that. So these are some of the portfolios that we are looking at. And of course, then the double B and below portfolio that we have, we are closely, monitoring that.
Okay, and just want to make sure that I get your ROE guidance right. It's 15% for FY20, right?
For June 2020.
For June 2020.
That's okay. Right. It'll be the first quarter of FY21.
Yes, got. Thank you.
Thank you. The next question is from the line of Joel Rebello from Economic Times. Please go ahead.
Just wanted to check your margins. The question was asked, but what was it in the same quarter last year? 3.72 this time, but what was it in the same quarter last year?
It was 3.24.
3.24. And you said that you've got the benefit of income tax refund. Adjusting for that benefit, how much would that be? How much would the margins be?
This year Q4 would be 3.52.
3.52, so 20 basis points basically. And you expect this benefit of low-cost deposits and the funding profile that you were talked about to continue for you in this fiscal as well? Can you throw some light on that?
Yes, given our deposit franchise, that is something we'll definitely strive for.
How much is the CASA? It's 49, right?
Yeah, period age. Yeah,
okay, thank you so much.
Thank you. The next question is from the line of Aparna Iyer from Mint. Please go ahead.
I was just seeking clarification on the international strategy you were saying. Can you elaborate a little more on that?
No, I said that we are looking at all our business segments to be growing on a risk-calibrated basis. So as long as they are focused on core operating profits, we would are doing this. More specifically, the international strategy has to support the Indian operations and the India linkages. So to that extent, it is going to be a bit calibrated.
Okay, so you're not looking at expanding further. You just...
No, we're not really looking at expanding.
All right, fine. Sure. Thank you.
Thank you. The next question is from the line of Ashish Akashe from Press Trust of India. Please go ahead.
So just one small clarification. The cost will be much more normalized from here on. So before the entire asset quality recognition started, what was the normal real January before this, sir? Hello?
In terms of provisioning, around 1% you can say is, where it would have been 1 to 1.2% in that region. But it's a function of the composition of portfolio as well. So that's why it's very difficult to give a number without the context.
Okay. So it's not like so the 1 to 1.2% range is not the aspiration which you might be really speaking about when you say that it would be normalized from here on.
No, that will be a function of the portfolio that we are running.
Okay, sir. Okay, sir. Thanks, sir.
Thank you. The next question is from the line of Joel Rebello from Economic Times. Please go ahead.
Sir, hi. This is Ashwin Manikandan from the Economic Times. I just wanted to know how your auto portfolio has performed in this quarter.
Performed in the sense? In terms of growth,
what's your number like? And any guidance you can give for the next fiscal, considering that there has been some stress, in some other banks.
There has been, some, slowdown in the market per se. But in terms of the credit, quality itself, there is absolutely, it's absolutely stable, and we have not seen, any stress there. Our, year-on-year growth on the, passenger car loans would have been in single digit. That is something which is there.
How would you compare this with the growth rate previous quarter or previous fiscal? Has it come down?
It has come down for the industry and for us as well.
How much has it come down? Can you give a number?
So I think for the industry also the growth was, upwards of or close to 15% in the past. It has come down to, single digit,
Okay, thank you so much.
Sir, one quick thing. Hello?
Yes?
Yeah.
Joel.
Sir, can you hear me?
Yes.
What is the ROE right now? That's the only number I wanted.
Just a second.
Yeah.
Given, as we said earlier, given the high level of provisions, which have been,
there is nothing much to write about that.
The ROE, of course, is, pretty depressed. It's around, for the full year is around, slightly more than 3%.
Okay. No problem. Thank you, sir. Thank you.
Thank you. The next question is from the line of Neha Botra from ET Now. Please go ahead. Neha, your line is in the talk mode. You may go ahead with your question.
Hello?
Yes, we can hear you.
Yeah. Okay. So, two questions. One, I wanted to know that what is your outlook for loan growth? What kind of mix are you expecting from the retail and corporate sector in the next year? Also, what are your write-offs for Q4 and FY19 fully provided for? Just wanted a clarification on that.
On the loan growth, we are looking at bank as a whole and not really focused on having a specific target between corporate and retail. But on an aggregate basis, we do expect as a bank to grow faster than the system.
How much?
I said we will grow faster than the industry.
Okay.
The loan write-offs, as we mentioned earlier, in fourth quarter is about 7,300 crores. For the full year is about 11,200 crores. And the same number last full year was about 8,600 crores.
All right. Okay.
Thank you. Ladies and gentlemen, that was the last question, and this brings the conference call to an end. On behalf of ICICI Bank, we thank you for joining us. You may now disconnect your lines. Thank you.